Matt, a lot of people sitting in this soft landing camp at this point based on all of the data we're getting, based on Fed commentary. It doesn't seem like you're quite ready to jump right into that soft landing scenario. Where do you sit at this point, and how do you see things playing out to start 24 here?
Inflation is cooling, and Federal Reserve policymakers are indicating that rate cuts are to come in 2024. But Wall Street is still at odds as to how the economy will shape up next year. So, is there any chance of inflation in the upcoming 2024? Let's find out through the lens of a prominent financial analyst. The Federal Reserve's interest rate hiking cycle has yet to tip the U.S. economy into a downturn. But RBC Global Asset Management put the odds of a recession in 2024 at 70%. For now, inflation has cooled, unemployment has remained low, and the stock market's major indexes are touching all-time highs. But RBC Strategist said their recession prediction is informed by the softening economic and business landscape. They shared some reasons why a recession will arrive in the first half of the new year. The Fed's rate hikes have gone high enough to trigger a downturn. The current policy is deeply in restrictive territory, and that stance may no longer be appropriate if the economy continues to slow or inflation continues to cool. Souring economic data suggests further weakness ahead. The firm's recession scorecard is flashing warning signals. For example, the 2-year and 10-year curves are inverted, as well as the 3-month and 10-year curves, both pointing to a recession. The scorecard also shows financial conditions and lending standards have tightened. RBC's business cycle model indicates the economy is vulnerable to a downturn, as it's currently late in the cycle. Central banks around the world are intent on cooling inflation to pre-pandemic levels, and they will likely have to produce a period of economic weakness to curb wage growth and pricing power. RBC said any recession will likely be reasonably mild and fairly short, and the labor market would see fewer job losses than typical. Still, a recession can be expected to inflict very real pain on businesses and households, and cascade into financial markets as well, the strategists added. The economy is headed for a recession sooner rather than later, and that could send stocks tumbling in the first half of 2024 before rallying again through year-end. Evercore ISI's Julian Emanuel said Matt Stuckey, Northwestern Mutual Wealth Management Senior Portfolio Strategist, and Yahoo Finance's Josh Schaefer and Brad Smith discussed predictions and how he believes investors should remain cautious. Stuckey lays out his reasons for rate cuts. Typically, when the Fed cuts, they don't cut 25 basis points at a time. They tend to cut in response to economic weakness. It wouldn't be surprising for us to see something chunkier than what the market is pricing in, albeit for a response to an economic weakness versus an insurance cut, to kind of modulate the real rate of interest that's out there in the economy. We don't have a specific number for you, but we do think it's likely to be a higher number than the market's pricing in, but for reasons like the surrounding recession versus trying to modulate a soft landing. According to Stuckey, a couple of months ago we would say that our call for a mild recession was kind of quasi-consensus, but over the last 2 months it's kind of moved into the contrarian camp. We haven't changed our view that the ultimate result of one of the fastest tightening cycles in the last 40 years is going to be some mild form of a recession in 2024. The U.S. economy, meanwhile, is slowly but noticeably slowing. Unemployment edged lower to 3.7% last month, but the labor market is starting to weaken. Meanwhile, American consumers are starting to slow down after a ferocious spending spree that lasted through most of 2023. That could set the economy up for a consumer-led slowdown, one strategist told, pushing the U.S. to the brink of a recession. Ultimately, though, a recession may present a buying opportunity for investors, Emanuel said, as he believed stocks would benefit from inflation continuing to fall in the back half of the year. He predicted the S&P 500 would rebound to 4,750 by the end of next year, representing a 19% upside from where he saw stocks bottoming in the first half of 2024. There's going to be enough event risk over the next 12 months, and there's enough tightening in the pipeline that there will be that temptation to sell low and buy high. and we don't want to do that, Emmanuel said. It's going to be a year where you're going to have to be patient, and ultimately, patience will end up being rewarded. Experts have warned of a potential recession over the past year as the Fed raised interest rates aggressively to lower inflation. High rates threaten to over-tighten the economy and send it into a downturn, with the New York Fed now pricing in a 50 chance the U.S. could tip into recession by November 2024. Wall Street, though, appears to be growing more upbeat. Investors and analysts are warming up to the prospect of a soft landing, with Bank of America and Deutsche Bank predicting the S&P 500 could notch a new all-time high in 2024 as the economy avoids a downturn. Investment banks and asset managers have wildly varying stock market and currency calls for 2024, reflecting deep division over whether the U.S. economy will enter a long-heralded recession and drag the world with it. The lack of consensus among forecasters is a stark contrast to a year ago, when most predicted a U.S. recession and rapid rate cuts that failed to materialize. The world's largest economy expanded by 5.2% in the third quarter of this year. The divisions this year have produced a scattergram of projections for the U.S. interest rate path and how global assets that are influenced by the Federal Reserve's actions will perform. Market participants are, therefore, bracing for a bumpy start to the new year after a strong rally last month for both stocks and bonds, based on a short-term consensus that inflation and interest rates are on a firm downward path. Whether the U.S. has a hard landing or a soft landing will dominate the market, said Sonia Laud, Chief Investment Officer at Legal and General Investment Management. The narrative isn't clear yet, she added, noting that if current interest rate forecasts were to shift significantly, that creates significant volatility. Economists polled by Reuters predict 1.2% U.S. GDP growth for 2024 on average. But while forecasters are united that the Fed's most aggressive rate hiking cycle in decades will cause a slowdown, they are split on whether 2024 will also include a couple of quarters of economic contraction that may prompt rate cuts and weaken the dollar. Amundi, Europe's largest asset manager, now expects a U.S. recession in the first half of 2024, meaning the group is negative on the dollar and likes emerging market assets. For U.S. stocks, which drive world equity markets, forecasters are divided between what Citi head of trading strategy Stuart Kaiser calls the converts and disciples of last year's strong recession consensus. J.P. Morgan views a recession as possible, and the S&P finishes the year at 4,200, while Goldman Sachs sees only limited recession risk. In foreign exchange, Japan's yen will be the market's bright spot, as the Bank of Japan is expected to finally move away from its ultra-easy monetary policy, said Amundi CIO Vincent Mortier. The yen is trading around 147 per dollar, not too far from 30-year lows. Morgan Stanley, however, sees no recession and reckons the Fed may keep rates high well into next year. It views the dollar index rising to 111 points from 104 currently, the euro dropping to $1, and the yen recovering only moderately to 142 per dollar. So that's all for today. What are your predictions for a recession in 2024? Comment down. And do smash the like button and hit the bell icon for more. See you.